Welcome students to Support Material 3. We're going to be continuing with investment management. We're looking at equity asset valuation, INV2701. When looking at the background, we're going to be focusing on a few more topics. These topics are going to be covering theory relating to fundamental analysis, technical analysis, and overall equity valuation. So when looking at study unit 6, which is fundamental analysis, let's think about this concept, fundamentals. What is fundamental analysis? And how would fundamental analysis help with decision making? Well, if you're thinking about the word fundamentals, you're looking at those basics in terms of the characteristics that a particular company has that provides you with more additional information about maybe the business model that they're incorporating, how they generate their income, and how they create value. So when you're looking at equity asset valuation and you're trying to establish what different businesses are worth, because remember, in investment management, you're trying to make investment decisions. In other words, you're trying to buy assets that are either undervalued or underpriced and then wait for the capital appreciation or the income in the form of a dividend that you would receive from the cash flow of that particular asset. And that's basically what you're looking at doing in an investment management consideration. So in investment management, you want to buy assets that generate future return on investment. So if we're looking at fundamental analysis, if you think back to 2008 or even more recently during the global pandemic, where we had that massive crisis, there's always going to be a push and pull in the market in terms of buyers and sellers. Sometimes the bears take over the market, and in a bear market, you obviously have declining prices, and in a bull market, you have increasing prices. So when looking at the market as a whole, there are certain fundamentals that are key that will either help a company navigate or survive certain recession type situations where they might not be as affected by certain market factors. So for example, if you're looking at the global pandemic and you're looking at the COVID crisis and how that affected the global markets, obviously many businesses chose to go online, and e-commerce was an area that all businesses had to consider because the world had changed. Obviously there were lockdown restrictions, etc. So when you look at fundamental analysis, you're basically focusing on the detailed characteristics, factors that you're going to be considering in terms of the business, in terms of how the business is made up, the management, the products, the services, the characteristics of those products and services. How do those products and services, in terms of demand and supply, how does that fluctuate in line with what's happening in terms of market trends, consumer buying behavior? And there's a lot of factors to consider. So when you're looking at fundamental analysis, you're basically trying to break down a particular company into its basics. In other words, you're trying to analyze the company as a whole, and you're looking at the fundamental facts and considerations that a particular company would have to consider that would make it either more or less likely to succeed in the future in terms of generating future returns on investment. So if we're looking specifically at how would fundamental analysis help you with your decision making, well, again, depending on your particular investment horizon and your investment goal, what are you trying to achieve and what sort of time frame do you have? You might be looking at investing in certain areas of the market because you feel very strongly about those areas. Maybe you really like technology and you want to invest in that particular area. Or maybe you like retail or telecommunications or banking. So that's all looking at your own personal views on different categories or different areas in the market. So when you look at fundamental analysis, just remember that you're trying to break things down to understanding in terms of its business practices, management, products, services, geography, where do they operate, which locations, etc. So to keep it simple, when we're looking specifically at fundamental analysis, you're trying to understand the business based on its fundamentals. And that's the word that I'm trying to stress in this particular section. All right, so think about this. If you were an investment analyst, what factors would you consider when making an investment decision? What news are you going to consider? So there's lots of different reports that can be presented to the market in terms of information. So the market, remember, is going to take that information that has been released and they're going to price that information into the market. So in other words, different assets will be priced based on the information that comes out. Simple example could be something like load shedding in South Africa. That will obviously affect certain companies more than others. So if we're looking at load shedding, that could be a factor. And if we're looking at investing in a particular asset, maybe you'd want to invest in an area that might benefit if there is load shedding perhaps, or you might invest in an industry where they are looking at providing electricity or alternative forms of energy. Whatever the basis of your analysis is and your personal view on various industries or various companies in the markets, you would definitely make your decision based on your preferences. So when looking at all of these different examples here, you might have a certain view on the economy. You might forecast or have a particular view on where you think the economy is headed. Is the economy headed into recession? Is the economy headed into an expansionary type environment, okay, where things are improving? So those are things you might want to look at. There could be market signals that you'd be looking at. Overall price or market indices. How well is an overall market doing? For example, the JSE Top 40 or the industrials or the financials. And then you might also have a view on interest rates. If you're looking at what's happening recently, since the global pandemic and since the war in the Ukraine, inflation has been a massive consideration. Prices have been increasing because of the war in terms of oil prices and inflation, supply chain aspects that have been affected. So when looking at interest rates, you're trying to understand, where do you think interest rates are headed? Are rates going to go up or are rates going to go down? And are rates at their highest or are rates at their lowest? So if you're looking specifically at decision making, where you're looking at investing in a particular asset, your job is to understand, well, what is my preference going to be? How am I going to make an investment decision? And what is that decision going to be based on? There could be lots of other considerations, something like economics, where you're looking at balance of payments, maybe even exchange rates. Which country are you going to invest in? Are you going to invest offshore? Are you going to invest locally? That's always something to consider. And then unemployment. How does unemployment affect certain businesses or industries? And would you invest in those areas or not? And then we spoke about inflation. There could be a particular view that you might have, and you might invest in areas where you believe that inflation would actually help increase those returns that you could potentially get in those particular assets that you're investing in. So just remember, when looking at fundamental analysis, fundamentals means what's your basis in terms of your criteria? What are you looking at when making your investment decisions? Are you looking at management perhaps? What sort of managers are leading an organization? You might choose to invest in particular companies because maybe you like the leadership. Maybe you've heard of some of these very well-known individuals, Jeff Bezos, Bill Gates. Right, those are individuals that have started and that they've grown companies. So their leadership, their management, their focus in terms of achieving long-term value is proven. So would you invest in a particular company just because of management leading a particular organization? And those are things that you would consider. So fundamentals is looking at that. Maybe a CEO steps down. What happens if, I don't know, Elon Musk decides to leave Tesla, or he decides to quit his role as the CEO? That's obviously going to affect the investor's view, or the investor's view or opinion, I should say opinion, in terms of what they believe Tesla will be worth with or without Elon Musk. So those are just things to consider. So remember, fundamentals could be anything related to business, anything related to the company. We're not looking at the price of the company in terms of share price. We're looking purely at other characteristics, facts, business models, strategy, competition, all of those different market factors. And that's what we're looking at here. We're looking specifically at fundamental analysis. So fundamental analysis is looking at those other areas that you might be considering that could change or affect your decision making. Right? You might be more or less inclined to invest in a particular area because of certain key views or considerations. So that's something to consider. Please remember that it's important to note what is your criteria when making an investment decision. Right, so the textbook takes you through these different approaches. The first is a top-down approach. You also get a bottom-up approach. So top-down or bottom-up, those are two different approaches when making decisions. So if we're looking at investment management, you're going to have to analyze what's happening in the actual markets before making a decision. So when you're looking at fundamental analysis, the top-down approach looks at large macroeconomic factors that affects everyone. So it doesn't matter which type of industry you're in. If you're in South Africa, whether you're a small business, big business, medium-sized business, it doesn't matter. Load shedding or the different rules and laws in the country will affect you. So if we're looking at the analysis of the macroeconomic factors, macroeconomic, if you've done economics, is looking at broader issues that affect all businesses, not specific businesses. So you might be thinking of, well, macroeconomic, that could be the GDP growth in a particular country, maybe the unemployment rate. So you might look at South Africa as a whole, and you might look at the country and say, well, okay, how well is South Africa doing? On a macroeconomic level, do you expect South Africa to grow as a country? And once you've decided on yes or no, then you're going to start looking at individual industries. Right, so if I assume that yes, Africa is a good country to invest in, then I'm going to look at different industries. Right, which industry do I think has the highest potential for a return on investment? Am I going to be investing in retail? Well, we know retailers have to stay open if they want to sell goods. And if there's lots of load shedding, they're going to need generators. That's going to add extra costs. And that could be a factor in terms of fundamental analysis that would affect my decision to invest in retail businesses. Okay, so shops selling goods, consumer businesses. Maybe I would invest in telecommunications. Obviously, people need to make phone calls. And this is something that you saw during the global pandemic, when everyone moved online and we were all using the internet. Internet businesses grew substantially. Facebook increased in value, Zoom increased in value, Apple, Microsoft, all of those technological companies that have these platforms, okay, these social networks or these online platforms that we can make use of to help do business online, increased significantly in terms of what was happening. So based on a macroeconomic factor and then looking at specific industries, certain industries will perform a bit better than others, depending on which industry you're in. Right, so healthcare or mining or banking or any other industry. It could be retail, it doesn't matter, but you're going to be breaking it down into different possible companies and then narrowing it down to specific shares. In other words, which ones are you looking at? And that's the bottom of this diagram. So just remember, when you look at these macroeconomic factors, you're starting high level, you're looking at the whole country, maybe even the whole region. So you might look at like different parts of the world. Okay, so America in terms of North America, South America, maybe Europe. Then you might look at Africa, you might look at Asia. It all depends. So macroeconomic, broader factors. Then you break it down and you look at industries. Which industries do I feel have the highest potential to generate a significant return on investments? And then after I've looked at the industry, then the last level is to consider these individual companies and which shares am I going to invest in. So for example, if I assume banking is a good area to invest in, which bank am I going to invest in? Am I going to invest in corporate banks, investment banks, retail banks? What banks am I going to consider? Or if I'm looking at telecommunications companies, Which ones am I going to invest in? Ones that have more maybe fiber networks in terms of infrastructure, or ones that have more 5G or 4G or whatever criteria you're going to be looking at affects your decision making, or it could be the management. Those are things that you would have to consider. Right, so when looking at fundamental analysis, remember, fundamentals is looking at facts. It's looking at news, looking at information relating to those organizations. Right, so this is this diagram just highlighting those macroeconomic factors. Remember, in the business cycle, you have lots and lots of different changes in the market, supply and demand. Okay, in economics, they talk about the business cycle. Right, markets go through good times and bad times. Sometimes things are going well and sometimes they're not. So we need to consider what is happening in the market. What are some of the indices telling us? Is inflation increasing? Is unemployment rising? Is GDP slowing? What factors do we have in terms of information in the market that helps us to make decisions? Right, so again, macroeconomic is high level, looking at all of these different possibilities and deciding on what we should be doing. Then, if we're looking at the different indicators that you could be focusing on, you could be looking at international, you could be looking at national, all right, local or global. Then you could be looking at these asset classes. Okay, you could be focusing on different measures. Right, economics is definitely helpful, especially when making investment decisions, because you need to know how well a country is performing. If you know a country is performing well, then you would definitely be inclined to invest. If inflation is rising, then also you need to consider inflation and how do we mitigate or reduce the impacts of inflation. So there are different measures that you could consider. These are just some of the different factors that you would consider that will give you more information to help you make an investment decision. Which areas I'm going to invest in. For example, if the repo rate is rising and interest rates are increasing and borrowing is becoming more and more and more expensive, then I need to decide, where am I going to invest? How am I going to offset high inflation? Which areas in the economy are going to do better than others? So just remember, there's something called a leading and a lagging factor. And this is something that the textbook also speaks to a little bit, where they highlight these leading or lagging indicators. For example, if you're looking at something like GDP or CPI, those are generally lagging indicators because they show what has happened in terms of price changes over the last month or the last year. And you're looking at what has happened versus a leading indicator. That could be something like maybe manufacturing, for example. Okay, you could be looking at the manufacturing numbers. And if businesses are manufacturing more, that could give you an indication that there is a leading potential indicator that there could be better than expected future economic growth, right? If businesses are creating or manufacturing more goods, that means they expect demand to increase or rise. So if demand is going to increase or rise, you would expect prices to increase, business to pick up, and those are things that you could maybe consider as a point or a reference that you could use when making certain decisions. Right, just something else to consider. This is more a discussion point. So this is something that you could maybe have a look at in your own time. Definitely do some research and look at these different companies that operate in and around the world. I'm sure all of you are familiar with the company Apple. Apple is a very successful company, not only because of the history in terms of Steve Jobs and how Steve Jobs had led the company from almost collapsing and failing to creating one of the world's most valuable companies in the world. And if you look at a company like Apple, which is the private sector, and then you look at the public sector, which is like the government, okay, the US government and the different public entities that you have in America, when you're looking at these macroeconomic factors, do you consider the American economy as being a safe place to invest in? Well, if your view is yes, then you need to consider, well, which companies in America are you going to consider investing in? And is are those companies in America going to be affected by the politics in America? So this is just a nice, interesting cartoon that basically asks the question, which is the better investment, the government or private sector? And again, there could be pros and cons to both. You can't invest directly into the government, but you can invest in a country because you believe that the government, the politics would lead you to believe that the future of the American economy would be better than today, or increasing or growing in the future. And then you could consider, well, private companies and how would they manage those type of situations, and also resources. If you go look at the numbers, which company or which entity has more resources, the government or the private sector? And you'd be quite surprised to know or to research and see what's actually happening. There are many very, very large global public companies like Apple. When I say public companies, listed on an exchange. Okay, so Apple as a public company will be listed on a stock exchange. Okay, we've spoken about this in a previous section, so just a note. And then obviously, if you're looking at the value that they're creating, one of the biggest question marks that we have is, well, do we invest in America? Do we invest in American companies? And obviously, which American companies are we going to invest in? And are we going to invest based on our view of America and their politics, and looking at their government and how the government is run and the debt in America, and is that going to affect other areas of the American economy? For example, maybe the private sector. Okay, private companies like Apple that have listed on a exchange. So when I use the word public, I'm referring to government. Okay, public company refers to a company listed on an exchange, and then you have private businesses. Okay, obviously businesses that would have started in the private sector and then have grown bigger and bigger and become these global massive businesses. Okay, then we've just got a note here about industries. So once we've chosen, once we've developed our view on a particular country, remember macroeconomic, high level, then we need to break it down further. We need to look at the industries that we're going to consider investing in. So Porter's 5 forces, this is something you might also have covered in some of your other modules, in theory modules relating to management or operations, where you're looking at threats from a buyer or seller, customers, consumers, competitors, all of those considerations. It's always something that you need to consider. So when we're looking at, remember, fundamental analysis. Fundamentals means looking at news, information. Right, so if I'm reading the newspaper and I see there's going to be a threat of new entry, let's assume that there's going to be a new entrant. Right, somebody else is going to enter into a particular market. It could be banking, it could be telecommunications, it could be retail, it could be anything. If there is a new entrant, someone that's entering the market, I don't know if any of you are following what's happening in terms of Amazon, but Amazon is actually building or creating an office in Cape Town to have a local operation in South Africa. So previously, Amazon was an American company and obviously operating in other countries as well, but not specifically in South Africa. And if you Google search and you read up about Amazon and what they're doing in Africa, they've started constructing a massive distribution center in South Africa. And at some point in time, they're definitely going to be competing with the likes of Takealot and other e-commerce business providers in South Africa. So, what does that do to that industry? How does that affect that industry? Where are we going to invest? Are we going to invest in Amazon just because they're expanding in Africa? And those are things that you would need to consider, especially when you're looking at a top-down approach. You need to basically break it down into different areas that you're going to be focusing on, and then choosing a particular company. And that's what we're trying to get to. Right, so just remember that there's lots and lots of different factors that will affect different businesses. When we're looking at these types of industries, we need to make sure that these industries are going to provide us with some sort of return on investment. So we could look at the actual economic factors or market factors that will affect certain industries. Right? Technology is continuously growing, expanding, improving. So technology is definitely an area that you might like and that you might want to invest in. Or maybe you'd want to invest in entertainment, or manufacturing, or construction, whatever it is. It's important to understand that industry. And where is that industry in terms of life cycle as well? Is that a new industry? Is this a new industry? Is it a expanding industry, a growing industry, or a stagnating industry? Just something to give you some context. For example, I don't know if any of you remember blockbusters and video rental. So that industry has changed. Previously, you would have to have bought a CD or a DVD. I mean, you can still buy CDs and DVDs now, but they're very, very, very hard to find. Nowadays, everything is digital. It's all streamed online using the internet. So when we're looking at industries, okay, the entertainment industry has changed drastically because of technology. And those are things that you could look at in terms of life cycle, competitiveness, and then overall input and output. Okay, in terms of input, how successful is that industry going to be going forward? All right, then our last step is trying to identify specific companies, individual companies that we're going to invest in. For example, I said retail as one of the examples. There's many, many retailers around. Which ones are we going to invest in? And what area are we going to invest in? Are we going to invest in retailers that sell clothing? Are we going to invest in retailers that sell food? Are we going to invest in retailers that sell luxury goods? Like which retailers are we going to invest in? That's something that we need to consider. So when we're looking at a top-down approach, the last step is to analyze these individual companies and to find shares that we consider being undervalued. Because if you want to buy something, you want to buy when that particular company is cheap. Okay, you want to buy at a cheap price. You want to buy shares at a lower price and then hold on to those shares, and hopefully those shares will increase in value and their prices will appreciate. So when we're looking at the analysis of these individual companies, just remember, you're going to be looking at specific measurements. And this is something we'll cover later on in this set of notes in support material 3. You will see some ratio analysis, and this is looking at detailed analysis focusing on a company. We'll look at things like profitability, liquidity, solvency. Those are all different areas that you can actually analyze and you can measure to determine how well or how badly a company is doing. Okay, if they're doing well, if they're doing really good, you'd obviously want to invest to generate some sort of return on investment. And then just some other things to consider: growth prospects. Does this company have any growth prospects? Do you think this company is going to grow? And if it is, how soon and what timeline? The management. If you think about Steinhoff, maybe you've done some research. Steinhoff had bad management. Okay, their management is now being investigated for fraud and accounting irregularities. So would you rather invest in a company that has good management or a company that has bad management? Those are things that you need to decide on. And this is all part of fundamental analysis. Think about the company life cycle. Where is that particular company? Is it a startup? Is it more mature? Or is it towards the end of its life? Maybe certain companies are going to close and stop operating. Similar to the example I spoke about earlier, blockbusters, and how nowadays you cannot rent DVDs or videos from a video rental store. It's all done online. And then we have other things like earnings, dividends, company expectations, and then obviously the company's unique strengths, weaknesses, opportunities, and threats. This is something that you would analyze for all these different companies to ultimately make a decision. Are you going to invest, and will you invest, and for what time frame? And those are things that would affect your decision making, especially when looking at individual companies and shares. Then just a little note here about the bottom-up approach. I don't know if you've seen this film. This was an amazing film showing what happened during the 2008 financial crisis. The film is called The Big Short. The actors are some of Hollywood's big names, and they basically tell the story of what happened in the American economy when Lehman Brothers went bankrupt. And it's a true story. It's all factual. It's based on actual real-world events and what happened during that time. So when we look at bottom-up, this is looking at identifying things from the bottom and then linking that to things higher up. And then it's actually the opposite. So you're focusing more on companies and then expanding broader. And that's something that you can also do when making an investment decision. You can look at bottom up or top down. It doesn't matter. Okay, the last two topics we're going to be focusing on today. We're going to be looking at chapter 7 and 8. This is focusing specifically on equity analysis. So this topic, the next part of this course, is going to be looking at equity analysis. So we've just looked at fundamental analysis. Study Unit 7, industry analysis, we're going to be focusing specifically on things that we need to look out for. Okay, we just spoke about how important it is to analyze different companies or countries based on a fundamental approach. Remember, fundamental analysis. Just to expand on industry analysis, this is looking at specific industries as a whole. Right, so a bit of a recap, some repetition here from what we just looked at earlier. If we're looking at a specific industry, something we need to consider is, well, does that industry get affected by the economic cycle? In other words, if there's a recession, is that going to affect the industry? If there's a recovery, is that going to affect the industry? And what impact will that have on the industry? So for example, food. Everybody needs to eat. So we always need to buy food to eat. So those are industries that are going to perform irrespective of what's happening in the economy. Whether things are in a recession or whether things are recovering, everybody needs to eat food, and we all need food, and we need to buy certain groceries. But if you think about maybe luxuries, during a recession, there might not be as much demand for luxury goods as if there was a recovery or a boom. So during a boom, when things are going well, people want to buy luxuries. People want to splash out on nice things, and that could affect those particular companies in that particular industry. So just remember, when looking at industry analysis, you need to always focus on where is the business currently and where is the industry. And we need to get some sort of market consensus in order to predict or help us make a decision in terms of what we're going to be doing. Are we going to be investing or not? And that's something that you would have to consider when making your decisions. So something that the textbook highlights is the different industry life cycles. So we have development stage, then introduction, then growth, then maturity, and then at some point, sometimes these industries decline. So a simple example would be something like when entertainment went digital and we had CDs and DVDs. That could have been a growth phase. And then we reached maturity, where everybody was buying CDs and DVDs, and there was a bit of a stagnation, and then eventually the decline came. The decline came when the internet blew up and streaming services started, and instead of buying content, CDs and DVDs, you could stream music, and you could stream videos and film and television even. So those are things that you could look at in terms of life cycle, in terms of the industry. How is the industry performing? What stage is the industry at the moment? And then again, just to recap on what we spoke about earlier, if you go look at your textbook, there's a whole list of leading and lagging indicators. Remember, leading indicators act as almost like a tool that can give you a signal of where the market could potentially be headed. So if we're looking at production numbers, claims for unemployment, new orders and contracts, or even money supply, That could be a leading indicator, leading meaning it could be a clue or a hint or almost like a signal that there could be a possible either improvement in the market or not. So that's just something we need to consider. So when we're looking specifically at leading and lagging indicators, leading is a signal of what could potentially take place or what could potentially happen. A lagging indicator would be something that would be based on history. So in other words, confirmation. In other words, giving us confirmation that we were right, that we thought something was going to happen or could happen, and that was confirmed with those lagging indicators. So both are relevant and both are useful when analyzing a particular industry. With lagging indicators, you could look at something like the duration of employment, the inventory sales, the rates, the loans outstanding, and the inflation. Those are all things that you might want to analyze. And then, just to highlight more theory in the textbook, the textbook takes you through all these different stages of the life cycle, and they talk about things that you should be considering. So in stage number 1, when I'm looking at the development stage, pioneering development, in other words, when businesses are starting, you want those businesses to grow, so you will see modest sales, you might see small or negative margins, you might have major development costs, but at some point you're going to reach stage number 2, which is going to be rapid acceleration, where everybody wants your product, everybody wants to purchase your products and services, and there's rapid growth. You've got growing demand, people want your products, people want your services, and then your margins increase and your sales grow. And this is something that you can see when looking at big companies like, especially companies that you've seen grow over a shorter period of time. For example, Apple. Apple's a really good case study that you might want to research and consider in terms of growth and how they've pioneered development, how they've seen rapid growth and acceleration. And they're obviously continuing to operate. And at some point, they will reach the later stages. And depending on your view, you might consider them being mature, maybe. Stage 3 talks about the mature growth, right, where growth has kind of stagnated. If you are following technology, maybe you would have seen some news about the new smartphones that are going to be released coming up in the next few months. And what Apple might be doing and what Samsung might be doing. Those are things that you'd want to analyze, and you'd want to have a certain view in terms of, do you think that industry is going to continually grow and expand? And what's next? Is VR and AR going to take over? Are we all going to be using those virtual reality headsets rather than cell phones? Like, what is the future going to look like in terms of technology? And that's something we need to consider when looking at mature growth. And then after mature growth, eventually, there's going to be some sort of stabilization where the market matures. And that's the longest phase generally, where industries start seeing some levels of decline or very, very slow growth rates, or almost like stagnant growth in terms of not growing significantly, but not losing market share either. So stage 4 is generally where they've like consolidated and they've grown as much as they possibly can. They've reached a maturity stage and now they're stable. Okay, for example, Apple is a well-known name. Samsung is a well-known name in many households in terms of their products and even their services. And those are things that you would want to consider. And then we're going to be looking at a level where there's going to be the decline, or the decline has started, where there'll be a deceleration of growth and an ultimate decline, where sales will be affected, less people buying those products, and just less interest in those products because they've reached that particular stage. And just remember, the focus here is deciding on which companies are we going to invest in. So if you look at the industry as a whole, then you're going to break it down to a company. You could do this for companies as well and look at their growth and look at their stages. So just remember, when looking at equity asset valuation, fundamental analysis, when we're looking specifically at equity valuation, okay, or industry analysis, we're looking at the industry as a whole and we're trying to make decisions based on how well those industries are performing, and we're trying to select which companies we believe are going to be doing the best. Right, this is just a little note, just highlighting everything we've covered so far. Just remember, when looking at industry analysis, it's important to define the industry. What industry are you actually looking at? Then look at the different business cycles that are applying. So are we in a recession? Are we in a boom? Is there growth or isn't there? Then looking at the individual industry, and then the industry structure, how much competition do we have in the industry, and then competitive strategies or forces. How much competition do we have in that particular area? And that'll help you. That'll help guide you in terms of making decisions on your investment decisions in terms of companies and industries to invest in. Right, so here's an example. Let's consider the car manufacturing industry. If you're looking at that industry, would you invest in that industry? Well, if it's electric vehicles, perhaps. Tesla has grown significantly. Tesla is one of the world's most valuable companies now, purely because of this massive boom in the electric vehicle industry, so the EV industry. So if we're looking at industry analysis, let's consider car manufacturing. Which companies are you going to consider investing in? Which companies do you think are going to be the future of the automobile industry? And that's something that you would have a particular view on. So the point I'm trying to make here is just do your research, do your analysis, and then once you've made your decision, once you've got your facts, then you can just start deciding on what is it that you should be investing in, which companies. All right, and then the final set of notes here is study unit 8, which is looking at the company analysis. So we're taking it much, much deeper. We're going to be focusing on a specific company. Right, in this area, we're going to be focusing on ratio analysis. Right, so financial statements. Right, you've covered financial statements in your accounting module, so you should have a pretty good understanding of what all of these 4 most important financial statements are. In accounting, the accountant will generate a statement of comprehensive income. An accountant would also create a statement of financial position, as well as the statement of changes in equity, and then the cash flow statement. So if you're looking at analyzing financial information, if we're looking at financial statements, your job is to analyze those financial statements to make sure that you have the detailed analysis. You know how profitable a particular company is. You know how healthy their financial position is. And all of this can be measured by looking at the accounting information. So accounting is an extremely valuable skill and tool that we need in investment management in order to take what we know from accounting and apply what we know in terms of investments to make decisions. Are we going to buy or are we going to sell a particular company? So when we're looking at the statement of comprehensive income, when you're looking at the statement, you will see income and expenses. The statement will give you more information about sales, cost of sales, other income, other expenses. And you could also look at other line items such as interest expense, taxes. If any of you are interested in company analysis, just go Google search your favorite public company. Please make sure it's a public company so you can get information on those companies, and then look at the financial statements and see if you can read information relating to the sales, the cost of sales, other income, other expenses, see how much taxes they've paid or interest they've paid, and then make certain decisions on how well the company is performing. Another statement to consider is the statement of financial position. In this statement, we're going to be looking at the assets and the liabilities. We're going to be focusing on their debt. All right, so in terms of liabilities, how overly indebted are they? Remember, if we take assets and liabilities, and if we subtract those two, if I take assets and I subtract liabilities, that's going to give me owner's equity. And owner's equity, if you remember your accounting knowledge, is basically a representation of value or worth. How much is the company worth in terms of net worth? Right. So when we're looking specifically at the statement of financial position, you're trying to analyze the company's position in terms of assets and liabilities. How many assets do they have? How many liabilities do they have? And if they've got assets and liabilities which are bigger, that's very important to note, especially if we're looking at financial position. Right, the position the company is in is important. We want them to be in a healthy position. We want their assets to be more than the liabilities. But we would want to invest in a company that has more assets than liabilities. Then if we look at the statement of changes in equity, here you'll see things relating to retained earnings. That's how much the company keeps within the organization. Just a little note in brackets, the retention ratio. Retention means how much of the profit does the company actually keep within its organization to use for future. So that would be the retained earnings. If profit is paid out, then that's considered a dividend, and there would be a payout ratio for that. Transfers, share issues or redemption, how much are the shares worth, how much shares have they issued, all of this relates to changes in equity. Remember, changes in equity relates to the owners of the company. So if we're looking at a company or a public company, because we'll be looking at public companies as examples, we mentioned a few, Apple, Amazon, Samsung, they're all public companies. And those companies will issue shares. Okay, they'll sell shares to the public. And then the last statement is looking at cash flow. And as the saying goes, cash is king. Cash is what determines how successful a company is. If there's more inflows than outflows, that's going to show positive cash flow, and we would equate that with a business that's generating its own cash reserves or money. Right? If a company can create its own cash or generate its own cash, that's very powerful. Then they don't have to seek external financing or finance. Right? So just remember, when we're looking at cash flow, inflows versus outflows, there are different sections. This would have been covered in accounting. You get cash flow from operating activities, you get cash flow from investing activities, and you get cash flow from financing activities. Those are all the different areas that you would want to analyze and look at in more detail to then decide on whether this company is generating cash or not. Right? If the company is generating cash, that company could definitely be seen as a good potential investment. And then just some additional notes regarding your financial analysis. You get statistical analysis, which is more quantitative, which is looking at number crunching. You get subjective analysis, which is qualitative, looking at qualitative analysis, for example, preferences and things that we like based on our emotion or based on our views or opinion. And then you have accounting ratio analysis, which is the most objective. Objective being statistical or quantitative, okay, where you're looking at numbers. Right, so the last bit in these notes just highlight all the different potential ratios or measures that you could be asked to calculate in a test type situation. So I've just given you formulas here. I've just listed them all. If you've done accounting, if you've looked at financial analysis, you would have covered all of these different ratios. So please just look at these ratios just as a bit of revision from a previous course. If you did accounting or even if you did financial management, you also would have looked at analysis, okay, ratio analysis. So I've just given you a summary of all the different ratios that you could potentially use in a subject like this one. Right, so net asset value, NAV, you calculate net asset value by comparing the assets to the liabilities, and you divide that by the number of issued shares. Return on equity, net profit over total equity. The dividend payout ratio, dividends over earnings. The dividend cover ratio, dividends per share over earnings per share. The dividends yield, dividends per share over the price per share. The price earnings ratio, the PE ratio. With PE, you're looking at how expensive or cheap a particular company is. Okay, those are all ratios that you're using to objectively measure how well a company is doing based on its performance. Book value per share, total assets over the number of shares, market to book value, market price over book value per share. And then you've got liquidity ratios. Liquidity is looking at your ability to meet your short-term obligations. Liquidity is basically, do you have enough money to pay for your short-term liabilities? So the current ratio, current assets to current liabilities, that measures your liquidity. The quick ratio, same thing, except you're taking out inventory. So current assets less inventory, what's remaining, divide that by your current liabilities will give you a ratio that gives you an indication of liquidity. And then net working capital is the difference between your current assets and your current liabilities. Then we've got asset management ratios. We're looking at inventory turnover. Inventory turnover is looking at cost of goods sold divided by the average inventory. Fixed asset turnover, also looking at sales, comparing that to our net fixed assets. Total asset turnover, looking at sales and comparing that to our total assets. There are some other ratios that help you looking at focusing on operations or performance. Here you've got the collection period. The accounts receivable collection period is calculated using accounts receivable divided by the sales divided by 365. Your payment period, your purchasing, when purchasing on credit, you have to pay your creditor. So you have a formula for the payment period. Accounts payable over cost of goods sold divided by 365. Then you have the average age of inventory, which is your average inventory divided by your cost of goods sold divided by 365. And then your cash conversion cycle, also something that you can analyze in terms of ratios and measures in order to determine how well a company is performing. Then we've got some debt management ratios here. Debt ratio, total debt over total assets. Total debt ratio, total assets minus total equity, divided by total assets. Debt to equity ratio, we're comparing how much debt we have to how much equity we have. Again, looking at what do I have more? Do I have more debt or do I have more equity? Then you have gearing ratios, long-term debt over total long-term debt plus equity. Cash coverage ratio, the earnings before interest and tax plus depreciation over interest expense. The times interest earned ratio, looking at earnings before interest and tax divided by the interest expense. And then you've got profitability. With profitability, you're looking at operations. In other words, income and expenses. Okay, you're comparing your income to your expenses to see how profitable you are. So a gross profit would be looking at the difference between your sales and your cost of sales. So a gross profit margin is the gross profit divided by the sales. Net profit margin is the net profit or the net income divided by the sales. Then you've got two other ratios, return on assets and return on equity. There you've got net income as the numerator divided by either your total assets or your equity. And then just a note, don't forget about DuPont. DuPont has come up in a previous module. If you've done your financial management module, you would have covered DuPont in detail. Just remember, return on equity, the DuPont model does apply. When looking at DuPont, you can calculate the return on equity by looking at the net profit margin, multiplying that by the total asset turnover, and then multiplying that by the equity multiplier. I've just given you a bit more information here regarding DuPont. What we just spoke about, return on equity, can be calculated using those three separate ratios. If I multiply those three separate ratios together, that gives me an indication of the return on equity for that particular business. Return on equity, if you expand each of those formulas, net income over sales, sales over total assets, and total assets over equity, you can see that you can actually cross-cancel these. Let me just show you what I mean. Okay, if you cancel sales with sales and assets with assets, you can see you're left with equity over net income, which is return on owner's equity. Right, so if you take all three of them, okay, there's the one, there's the other, and there's the other one there. All right, if you're multiplying them all out with cross-canceling, you're actually going to be calculating return on equity. And that's it for this set of notes. Thank you for watching this video. Just remember, when looking at investment management, you're always going to be looking at these different considerations. Okay, remember, fundamental analysis is key when understanding a business. Make sure you understand the macroeconomic variables, factors, then break it down to the industry, and then ultimately take it down to a company, and then analyze each company individually to make a decision on whether a company is doing well or not.